Before we begin, I need to be absolutely clear. Nothing in this video constitutes financial advice. I am not your financial advisor. Every person's situation is different, and you should consult qualified professionals before making any investment decisions. This is educational content only, presenting historical patterns and questions for you to explore with your own advisors. If you observe carefully what's happening in the bond market right now, you'll notice something worth examining. The asset that's been marketed as the safest, most conservative investment for retirement portfolios may be facing conditions it hasn't experienced in over 40 years. I'm talking about bonds. For decades, financial advisors have recommended the classic 60-40 portfolio, 60% stocks, 40% bonds. That strategy worked brilliantly from 1980 to 2020. But some investors and analysts are now asking whether the conditions that made bonds successful have fundamentally changed. What I'm about to share represents one perspective on these questions, but I want to be clear up front. I could be completely wrong about this. This isn't a prediction. It's an analysis of historical patterns and current conditions. I've spent over 40 years studying economic cycles, debt crises, and market dynamics across different countries and time periods. When you understand incentives, you understand behavior. And right now, the incentives facing governments, central banks, and institutional investors raise questions about traditional bond performance. Let me give you 3 data points that frame this discussion. First, the U.S. federal debt now exceeds $36 trillion, with interest payments consuming over $1.1 trillion annually, more than defense spending. Second, the Congressional Budget Office projects that even under optimistic scenarios, deficits may remain above $1.5 trillion annually through 2030. Third, real yields on 10-year Treasury bonds, when adjusted for actual inflation, remain barely positive or negative in some calculations. These are facts, not opinions. What they mean for the future is open to interpretation. To understand the questions around bonds, you need to understand the fundamental mechanism at work. Think of government debt like a reservoir. For years, the reservoir has been filling with water, debt obligations, entitlement promises, pension commitments. The reservoir has limited capacity. Historically, governments facing this situation have had 3 options: raise taxes dramatically to pay down debt, cut spending significantly, or manage the currency in ways that reduce the real burden of debt. History shows us that governments most frequently choose the third option because it's politically easier, though this isn't inevitable. If conditions unfold similarly to past patterns, bondholders might face challenges. But there are also scenarios where this doesn't happen, which we'll explore later. Again, this is not financial advice. I'm presenting historical analysis for educational purposes. Your decisions should be made with qualified professionals who understand your specific circumstances. History is an excellent teacher when examining what has happened to bonds during similar periods. Let me walk through 3 critical historical examples, but I want to emphasize that these are historical observations, not guarantees about the future. In 1971, President Nixon closed the gold window, severing the dollar's link to gold. In the decade that followed, bondholders faced significant challenges. If you held $100,000 in long-term Treasury bonds in 1971, by 1981, the purchasing power of that investment had fallen to approximately $40,000 after accounting for inflation. The nominal value stayed roughly the same, but inflation ran at 7 to 9% annually, while bonds yielded 6 to 7%, creating negative real returns. However, it's important to note that someone who held those bonds to maturity still received their principal back, and bonds served as a stabilizing force compared to stocks during some periods of that decade. The second example is the United Kingdom in the 1970s. British government bonds, called gilts, were considered among the safest investments. From 1972 to 1975, gilt holders lost approximately 45% of their purchasing power as inflation surged. But again, context matters. Those who needed stability and regular income still received payments, and bonds recovered in the following decades. The third example is more recent and particularly relevant. From 2020 to 2022, when inflation surged unexpectedly, the Bloomberg U.S. Aggregate Bond Index fell 13% in 2022 alone, the worst year for bonds in modern records. Investors who thought bonds were safe watched their holdings decline while inflation eroded purchasing power. However, bonds recovered significantly in 2023, demonstrating that short-term performance doesn't always predict long-term outcomes. Now let me present the strong arguments for why my concerns might be wrong and bonds could perform forward. This is crucial because there are many smart people who disagree with my analysis, and they have compelling points. First, consider the 1980 to 2020 period. Bonds delivered one of the greatest bull markets in financial history. Someone who invested $100,000 in long-term treasury bonds in 1981 saw that grow to over $2 million by 2020 through price appreciation and reinvested interest. Financial advisors who recommended bonds weren't wrong. They were right for 40 consecutive years. That's an extraordinary track record that deserves respect. Second, bonds have proven their value during stock market crashes. In 2008, when stocks fell 37%, long-term treasury bonds rose over 20%, cushioning portfolios and providing liquidity when investors needed it most. In March 2020, when stocks crashed 34% in weeks, treasury bonds provided stability. This portfolio stabilization benefit has real psychological and financial value that shouldn't be dismissed. If stocks enter a severe bear market or we experience deflation rather than inflation, bonds could outperform significantly. Third, central banks might successfully navigate this situation. The Federal Reserve has sophisticated tools and smart economists. They might thread the needle, bringing inflation down to 2% without causing recession or letting it run hot. If they succeed, bonds at current yields could perform quite well. Technology and AI might drive productivity gains we haven't seen in decades, allowing the economy to grow its way out of debt problems. This would be positive for bonds. Fourth, demographic trends could shift. If birth rates recover or immigration increases, the worker-to-retiree ratio improves, making entitlement obligations more manageable. Geopolitical tensions might ease, reducing defense spending needs. Congress might actually implement fiscal reforms. Any of these scenarios would change the entire analysis. Fifth, there's the psychological value of bonds that's hard to quantify. Many retirees sleep better knowing a portion of their portfolio is in safe assets. The stress and volatility of being 100% in stocks or alternative assets might lead to poor decisions at exactly the wrong time. Sometimes the mathematically optimal allocation isn't the psychologically sustainable one. Remember, nothing here is financial advice. These are questions and historical observations to discuss with your own qualified financial professional who knows your specific situation. Let me present 3 plausible scenarios for how the future might unfold, because the reality is we don't know which will occur. Scenario 1 is the high inflation scenario that concerns me. In this scenario, government debt remains unsustainable. Political pressure prevents spending cuts, and inflation averages 4 to 6% annually for the next decade, while bond yields stay suppressed due to debt service concerns. In this environment, bondholders might face cumulative purchasing power losses of 20 to 40% over 10 years. This is possible, but not certain. Scenario 2 is the deflation scenario where bonds could excel. Perhaps AI and technology cause massive productivity gains and labor displacement. Perhaps a severe recession hits, or China's economy implodes, creating global deflationary pressures. In this scenario, central banks cut rates aggressively, and long-term bonds might generate 30 to 50% returns as yields fall and prices rise. This has happened before in Japan and could happen here. Scenario 3 is the muddle-through scenario. Perhaps we see moderate inflation around 2.5 to 3%, moderate growth around 2%, and bonds deliver modest positive real returns of 1 to 2% annually. Not great, not terrible, just adequate. This might be the most likely outcome, frankly. The point is that presenting only one scenario as inevitable is intellectually dishonest. The future is uncertain, and humility about predictions is essential. Some investors are exploring questions about alternative approaches to the traditional bond allocation, though again, these come with their own significant risks that must be understood. Questions to discuss with your financial advisor might include: what role do Treasury inflation-protected securities play compared to traditional bonds? What are the historical risk-return profiles of real estate investment trusts compared to bonds? How have commodities performed during different economic environments? What are the tax implications of different asset classes? But before anyone considers alternatives to bonds, the risks must be clearly understood. Real estate investment trusts can fall 50 to 70% during financial crises. In 2008-2009, REIT indices fell over 60%. In 2020, they crashed 40% in weeks. They're far more volatile than bonds and carry leverage risks, interest rate sensitivity, and economic exposure. Gold and commodities can be extremely volatile. Gold fell 45% from 1980 to 2000, a 20-year period where you would have lost half your money. Commodities crashed 75% from 2008 to 2020. These aren't stable alternatives. International stocks carry currency risk, political risk, and can underperform U.S. markets for decades. Treasury inflation-protected securities have complex tax treatment where you owe taxes on inflation adjustments you haven't received yet, creating cash flow problems. This is educational content only. Do not make investment decisions based on YouTube videos. Consult qualified professionals who can evaluate your specific circumstances, risk tolerance, time horizon, and financial goals. Let me share a more balanced version of a historical comparison. In 2007, imagine two families, the Johnsons and the Martinez family, both with approximately $750,000 saved for retirement. The Johnsons followed conventional advice, 60% stocks, 40% bonds. The Martinez family took a different approach with higher exposure to real estate and commodities, lower bond exposure. By 2017, the Johnsons had approximately $1.1 million, while the Martinez family had roughly $1.35 million. The Martinez family had outperformed. But here's what often gets left out of these stories. The Martinez family experienced far more volatility and stress. In 2008, their REIT holdings crashed 60%. They watched $100,000 disappear in months. The psychological toll was enormous. Many investors in their position panicked and sold at the bottom, locking in catastrophic losses. From 2011 to 2019, their gold holdings went nowhere while stocks surged. The Johnsons' boring 60-40 portfolio compounded steadily with less drama. In March 2020, the Martinez family's REITs crashed 40% again. More sleepless nights. More temptation to abandon the strategy. The Johnsons' bonds actually rose during this period, providing stability exactly when needed. The Martinez family's higher returns came with higher volatility, more complexity, more tax complications, and significantly more stress. Some people can handle that, many cannot. There's no perfect winner here, just different trade-offs based on individual circumstances and temperament. Individual circumstances matter enormously, which is another reason why generic advice is dangerous. If you're 70 years old and portfolio dependent for income, your situation is completely different from someone who's 45 with decades until retirement and a pension. If you're 70, you might need bonds for stability and income, regardless of long-term return expectations. The psychological security of receiving regular interest payments and knowing your principal is safe might outweigh optimization concerns. If you have a pension covering all basic expenses, you can take more risk with your portfolio. If your portfolio is your only income source, you probably can't. Tax situations differ dramatically. High-income earners in California face different considerations than retirees in Texas with no state income tax. Municipal bonds might make sense for some, none for others. Health considerations matter. If you have serious health issues, a 30-year analysis is irrelevant. Many smart people disagree with my concerns about bonds. Jeremy Siegel, a respected professor at Wharton, has argued that productivity gains from AI could be transformative, changing the entire economic equation. Ray Dalio himself has shifted his views multiple times, acknowledging uncertainty. Mohamed El-Arian has presented nuanced views that don't fit simple narratives. The bond market itself, the largest, most sophisticated market in the world, continues to function with trillions in daily volume. Are all those institutional investors wrong? Maybe. Or maybe they see something I don't. Central banks might successfully control inflation through tools we don't fully understand yet. The relationship between debt and inflation isn't as mechanical as simple models suggest. Japan has run massive deficits for 30 years without inflation until recently. Questions you might want to ask your financial advisor include, how does my current allocation align with historical periods of similar debt levels? What would happen to my portfolio in different inflation scenarios? What's my actual need for bonds versus my psychological comfort with bonds? Am I confusing safety of principal with safety of purchasing power? What tax implications exist for different rebalancing approaches? How does my pension or Social Security affect how much portfolio risk I can take? What withdrawal rate am I planning? And how does that affect optimal allocation? These are questions for discussion, not answers I can provide. Again, this video is educational only. I am not providing financial advice. Your circumstances are unique, and decisions should be made with qualified professionals who can evaluate your complete financial picture, not from watching videos. If someone were exploring alternatives to traditional bonds, and I emphasize this requires professional guidance, they would need to understand implementation risks. Moving large portions of a portfolio creates tax consequences. Selling appreciated bonds triggers capital gains. Alternative assets have different liquidity profiles. REITs might take days to sell during stress periods. Commodities can be tax inefficient. The transition itself carries risks that might outweigh benefits. This isn't something to do based on YouTube videos or fear. If changes make sense for someone's specific situation, they should be gradual, carefully planned, and implemented with tax and financial planning professionals who understand the complete picture. The psychological aspects of investing are often more important than the mathematical aspects. Studies show that investors who frequently check their portfolios and react to volatility tend to underperform those who set appropriate allocations and ignore short-term noise. A 60-40 portfolio that you can stick with through volatility might outperform a theoretically optimal portfolio that causes you to panic and sell at the worst time. This is why there's no one-size-fits-all answer. Your psychological makeup matters as much as the economic analysis. Some observable facts that people are discussing. Central banks in Poland, China, Singapore, and Turkey have been increasing gold reserves while reducing some treasury holdings. This is factual and public information. What it means is open to interpretation. Maybe they're diversifying. Maybe they're preparing for monetary system changes. Maybe it's political posturing. We can observe the actions without being certain about motivations or implications. The U.S. debt service costs have risen to over $1.1 trillion annually. That's a fact. Whether it becomes unsustainable and when is speculation. Let me be absolutely clear one final time. Nothing in this video constitutes financial advice. I am not a registered investment advisor. I am not your financial advisor. This is educational content presenting historical patterns, economic analysis, and questions to explore. Every person's situation is different based on age, income sources, tax situation, risk tolerance, financial goals, health, and psychological factors. What makes sense for one person might be completely wrong for another. You must consult with qualified financial professionals, plural, perhaps a financial advisor, tax advisor, and estate planning attorney, who can evaluate your complete circumstances before making any investment decisions. Do not make changes to your portfolio based on YouTube videos, including this one. Show this content to your professional advisors for discussion, but let them guide your specific implementation based on your unique situation. I could be completely wrong about everything I've presented here. The future is uncertain. Smart people disagree. Central banks might successfully navigate this period. Technology might solve productivity problems. Political conditions might change. The analysis that seems logical today might look foolish in hindsight. Intellectual humility requires acknowledging these possibilities. That's why this channel exists, not to provide answers, but to present questions, historical patterns, and analytical frameworks for you to explore with qualified professionals. We observe data, study history, and analyze incentive structures. But we recognize the limits of prediction and the importance of individual circumstances. If this analytical approach resonates with you as worth discussing with your own advisors, consider subscribing. We'll continue examining economic patterns, historical precedents, and questions worth exploring. But your decisions should be made with professionals who know your complete situation, not from videos. The responsibility for your financial future rests with you and your chosen advisors, not with content creators on the internet. Thank you for watching, and please, consult professionals before acting on anything discussed here.